Okay, quick preview on the Fed minutes that are coming out at 2 p.m. Eastern, 11 a.m. Pacific time today. These are going to be a massive deal because these are going to be the minutes from literally during the banking crisis. So, March 22nd was the meeting. The Federal Reserve usually makes their decision on interest rate increases about 2 weeks prior to their Fed meeting. So, in other words, the Fed might be making their decision today for whether or not we're going to get that 25 basis point hike in May, at the beginning of May, May 2nd. I believe that we will. Now, I believe that we will because I think it would be a good that the Federal Reserve ends up going for a 5% terminal rate. Psychologically, it would be good for anchoring inflation. And keep in mind that meeting starts on the 2nd. The actual announcement will be on the 3rd. So I just want to clarify that. So I do think the Fed will end up going for 25 BP, and we'll probably see the market continue to price in a slight tilt towards that 25 BP. But anyway, these minutes will show us how the Federal Reserve balanced inflation and the banking collapses of Silicon Valley Bank, Signature Bank, and the other banks that collapsed as well, and the drama going on with the regionals, potential for a bank run, how they responded. So, what to expect? Here's an outline of what to expect. First, officials comparing scenarios for should they keep hiking? What about quantitative tightening? How do the new liquidity facilities affect quantitative tightening? Is it possible that as the Fed balance sheet goes up, they can keep raising interest rates? I mean, aren't those counterintuitive to essentially, on one hand, be printing money and on the other hand, be raising rates? We expect today in those minutes to see the evaluation of how they came to the decision to make sure to keep fighting inflation. And one of the things that I'm going to be looking for in the minutes, let's make a list of things that we're going to be looking for in the minutes. So the first thing that I would be looking for in the minutes is going to be economic strength. That's probably one of the most important things in the market right now is we want to see that the economy still has strength. The Atlanta Real Now GDP forecaster shows that we're still above 2% for real GDP. The Fed expects GDP to fall as low as 0.4% by the end of the year via their last summary of economic projections. What went into that? What data went into their projection that GDP is going to fall to 0.4% by the end of the year? And I want to see in the minutes what contributed to their fear that GDP was falling. And they believe that we could still hold GDP positive. So the first thing I would write this down to prepare for the minutes. Number one, write down economic strength. That is probably going to be one of the most important takeaways from this next minutes report. Forget whether we're going to get 25 or not. 25 or not is going to be a fart compared to whether or not we go into a recession. Whether or not we go into a recession, that's going to be the big deal. And so focus on economic strength in these minutes. Number two, obviously, any kind of hints for getting to a terminal rate and further banking stress. And then number three, I'm going to write down their analysis of the credit crunch. I would expect something like, look, we've already seen a credit crunch. Are we seeing any accelerating of a credit crunch? The fourth thing I'm going to be looking for is any kind of housing indicators that they're seeing. Obviously, we've seen extremely tight supply, which has led housing prices to actually start trending up again, despite interest rates remaining relatively high. So focus on those here. Then the fifth thing and the last thing that I would focus on in the minutes is any kind of commentary on how quickly they want to get inflation down. So the timing of inflation down. And so those are going to be, we're going to be looking for words like average, opportunistic, flexible, any kind of average. Well, we already said average 2%, right? Fate. If we get any reference to fate, it would be a game changer. I suppose a sixth thing that I would be looking for would be also any kind of suggestions on the timing of services disinflation. When do they need to see services disinflation? Remember, super core today came in at 0.4% for super core inflation, super core CPI, and maybe the timing of housing disinflation, because even though we expect to see housing disinflation, we just went from 0.8% to 0.6%, which is great, but it's still hot. When are we really going to see that roll off? JP Morgan believes we're going to see that roll off somewhere around June or July. We're sitting just now in getting the March data. So maybe we're still 3 months away from getting that housing disinflation. Can the Fed reiterate that 3 month away housing disinflation? What about services disinflation? If we're at 4.4% super core right now, that's 4.8% annualized. 4.8% annualized is obviously way too high. And if we're at 4.8% annualized, when is that going to come down? How patient is the Fed willing to be? Does the Fed think if they can pause at 5%, will CPI super core come down? Remember, super core is really those services x housing. I do not believe, and I'm going to write this down as number 9. This is going to be the start stop. A lot of people think that the Federal Reserve could just pause now and then pick it up again. In fact, one of the new Fed board members, Mr. Goolsbee, which when you write it, it's really funny, but I feel bad for him. But when you write Goolsbee, the autocorrect changes it to Foolsby. And he wrote or said in an interview yesterday, prudence and patience to assess tighter conditions would be wise. And he suggested holding on further rate hikes until they have more information. But that suggests the start-stop method. I don't think they're going to go for start-stop. The reason I don't think they're going to go for or stop, start, stop, start again is because that's the mistake they made in the 70s during Aaron Burr and his Federal Reserve governorship. What the Federal Reserve did is they raised rates, and then they saw the economy slow, and then they paused and cut rates, and then inflation reanimated, and then they raised rates again. And they basically kept trying to adjust the temperature of the stove without considering the lag time that it takes for the heat to actually get to the food. And then they kept overcooking the food and undercooking the food, overcooking, undercutting. And it's like, stop touching the damn dial. Just set it and forget it. And then cook with that. And so the reason that's a problem is when you have that method is people watch you cooking at the stove and they're like, you've lost your marbles. You don't know what you're doing. You have no control over what's going on. And when people believe that the Federal Reserve has lost control, which believe me, plenty of people already believe the Federal Reserve has lost control and that they're nut jobs. I get it. Okay. There are plenty of people who hate the Fed. And I don't want to come across as a Fed apologist because I agree. I think they've made some mistakes. But I think they could still end up being right on transitory inflation, which is fantastic, or would be fantastic for the Nike swoosh recovery, which is obviously something we're making a bet on, putting our money where our mouth is. But what I really want to focus on here is saying that the Fed's not going to repeat that. So I really doubt we're going to get any kind of like pause and then restart. If the Fed pauses, they're done. I want you to write that down. Hold me to that. If the Fed pauses, they are done. This tightening cycle is over if that pause occurs. Now, what I will say is the 5-year break-even rate is still a little on the high side. I'd like to see this come down substantially. I'm going to show that on screen here in just a moment. Let me pull that up. Do keep in mind today is a coupon expiration day. Prices will be going up for those programs on Building Growth today. Email us for a bundle coupon code at kevin@meetkevin.com if you'd like to bundle up. So what do we have right here? Well, what we have is the 5-year break-even chart. This goes all the way back to the beginning of 2022. Let me also go back to the 5-year. But look at where we sit. Unfortunately, we still have some work to do here. We really want to see, in order to see rate cuts, we would love to see this get down to about 1.6%. And while we've got a rough downtrend. The downtrend was a lot better right here. We broke that downtrend because of the January data. This downtrend was broken. Now we've got kind of a crappier trend, so to speak. If we could get back down to trend, we'd be over here at 2.15. Hopefully we trend down to this level. And inflation break-evens are so important because they're really a way of the Fed saying, hey, as long as inflation expectations are anchored, we're okay. We don't have to keep raising rates. And that's good. But as soon as this really breaks out, which it really started to going into the banking crisis, you end up having problems. Now, if you go back to 2018, you'll see that we actually have to get this right chart all the way down to about 1.6% to iterate Fed cuts. So that does indicate we still have some work to do with the Federal Reserve. We'll see. We'll be getting those minutes today. I'm excited to see what happens. So we'll see. Somebody here just donated $4.99 to talk about the 0% mortgage with 0% down. It's only for 2,500 people. It's classic California clickbait. 2,500 people. That's it. And then the program's out of money. Yes, it's a good program. Yes, I've already gone through it. Yes, I've already talked about it. But 2,500 people is not a lot of people. So it's not really worth talking about. Anyway, with that said, Thank you so much for watching. I've got to get ready for the course member live stream. Remember, you get lifetime access to all of the course member live streams if you join the programs linked down below. Not only do you get lifetime access to all of the programs when either of the programs you buy, you get all the access to all of the content within them and lifetime access to the live streams. You anytime we add new content, you get that for free. My goal is to really provide more value, and I'm convinced that if you go through the lectures that are in any of the courses, stocks and psych, 0 to millionaire real estate investing, do-it-yourself property management, real estate agent sales, YouTube content creation, you're going to learn a perspective that nobody else has talked about before. People like to make this argument, oh, I could Google the information. You can't, A, because it's my perspective and my theory on how to advance in any of these worlds, and B, even if you could, you wouldn't even know what to Google. And so that's what's so beautiful about these courses. It puts everything in order for you of exactly how to build perspective, learn everything that I do on the perspectives that I have for various different industries. And I encourage you to check that out, link down below. So thank you so much for being here. Wish you all the best. And I pray that the Nike swoosh holds so we can continue on our path to recovery. Today's CPI data was fantastic. Let's hope that the minutes continue to reiterate that. And we'll see you in the course member live stream in a few minutes. Thanks so much. Goodbye and good luck.